Hey, hello, and welcome, everybody. I'm Vern Cushenberry, your Chief Investment Officer, and I'm back with another market update. And leading the headlines is Venezuela. So I want to touch on that, give you a high-level overview and the bottom line up front, and then jump into some data. The headlines coming out of Venezuela remind me a little bit of the geopolitical risks of the last 4 quarters. If you'll remember, the last time we connected, we were talking about a government shutdown that lasted right up to the longest of all time. The quarter before that, we were talking about the bombing of Iran's nuclear facilities and the passage of the One Big Beautiful Bill. The quarter before that, we were talking about tariffs that we hadn't seen the magnitude of since the 1920s, 1930s. And the quarter before that was Trump's election. So it has been a roller coaster of a year on a geopolitical landscape. But the markets have digested all of these news with a little volatility, but inside of a bull market. And I don't expect anything that I'm going to be telling you today would cause a well-diversified investor to correct course. So I will share with you at the end of this presentation a little bit of timeless investing wisdom, as I always do, and encourage you to benefit from diversification and the wisdom of a financial advisor that helps you navigate your own path. So, having said all that, I want to touch on valuations, I want to touch on jobs, inflation, and talk about a few pockets of opportunity that we have mentioned over the last few quarters. You can see here the market's done very, very well in 2025. The S&P 500 was up 18%, and international markets were up over 20%. And let's put that into context. I share this chart every quarter because valuations are important and stocks are expensive. That's not new. We've been talking about stocks being expensive for the past few quarters. They're bumping up against their historical, top end of the range. They're not quite as expensive as they were during the tech bubble, but close. We need to see earnings growth. The markets have made a big bet on artificial intelligence and the earnings growth that is expected from that. And you can see that here on the next slide. The Magnificent Seven, as they're called, comprised of Apple, Amazon, Google, Meta, Nvidia, and Tesla. They've been driving the markets. And I want to direct your attention up here to this slide. The green is the performance of the Mag 7. The blue is the performance of the remaining 493 stocks in the S&P 500. And then you have the gray, which would be the weighted average of the S&P 500. Now look at this bottom line here that shows return share. If we look back at the last, 4 years really, what we recognize is that the Mag 7 have been responsible for over 50% or close to 50% of the total return to the market. And that cuts both ways. If you look at 2022, markets were actually down by 19%, and the Mag 7 comprised 57% of that downturn. So if we exclude the Mag 7, if we exclude all those gains that we've experienced from tech and artificial intelligence, the markets are much more reasonably priced. And those are the pockets of opportunity that you've heard me talk about the last several quarters. Okay, next I want to revisit one of the big topics from 2025, which were tariffs. And then I want to segue into the secondary effects from those tariffs, which you would expect to be jobs and inflation. And this chart shows where we expected tariffs to be when they were announced on so-called Liberation Day. They were announced at a rate that we expected to be approximately 30%. And you can compare that to the historical tariffs. You have to go all the way back to the early turn of the 20th century to see anything like that. What we actually experienced was something much less. And going into 2026, we now expect that effective tariff rate to be approximately 15%. You can see here on the bottom line of this chart what we've actually experienced. If you look back at the last 3 months we have data for, the effective tariff rate was around 10%. So not all of the effects of tariffs have worked their way through the economy yet. We expect them to be maybe a drag on the job market, maybe inflationary in their net effect moving forward, but the markets have digested this pretty well to date. Okay, let's look at jobs, because part of the justification for those tariffs were the reshoring of jobs that had been offshored going back to the mid to late 90s with the signing of NAFTA and then other trade agreements throughout the next 20 years. What we've seen in 2025 is that none of those jobs, or very few of them, have reshored, and that time frame is really too short for us to have had that expectation. But what we have seen are job openings begin to fall. We've seen new hires begin to fall, and we've seen layoffs begin to rise. And the unemployment rate has begun to rise. Not to an alarming rate yet, but that has been a key data point that the Federal Reserve has looked at in adjusting their primary tool, which is interest rate policy. Interest rates have been on the decline, and we expect one or two more interest rate cuts moving into 2026. Also moving into 2026, we expect a mitigating factor, which is stimulus from the OBBB, the one big beautiful bill. You can see on this chart that stimulus is front end loaded. So we'll see an approximate, and this is from the Congressional Budget Office, we'll see an approximate 0.9%, so just round up to 1% impact on GDP growth in 2026 from that one big beautiful bill. So that's a silver lining that we can expect, and that stimulus is primarily going to be coming from tax incentives to corporations to invest more in America. Okay, let's take a look at inflation. We expect the impact from tariffs to be inflationary, and they have been to a certain extent, but I'd say that has been measured. The latest print on inflation came in at 2.6%. You can see that here. This will be a key factor going forward, and it's a linchpin because it'll determine how much flexibility the Federal Reserve has to stimulate the economy or moderate the growth of the economy, as the case may be. And this time of year, I look at dozens of financial forecasts because every prognosticator on Wall Street has a forecast for the new year. And this is the single data point that has the widest dispersion. So the forecasts are all over the map, which tells me that nobody really knows what's going to happen with inflation moving into 2026 and beyond. I would point your attention to the green bars on this chart. This is energy, and this shows inflation going back to 2018. And you're looking at the primary components. So green is energy, blue is shelter / dining and recreation. Look at the impact of energy moving into COVID. We had a huge impact moving into COVID, and then beginning 2023, the opposite was true. You can see the green bars on the bottom side of the line there. They were a detractor from overall inflation. And I think the administration has been honest that oil played a part in the invasion of Venezuela. At one point in time, Venezuela was producing 4.5 million barrels of oil a day. Now they're down to around 1 million of barrels of oil a day, and the investment required to get them back up to so-called peak output is in the hundreds of billions of dollars. So that output would go a long ways towards keeping energy in check, and energy goes a long ways towards keeping inflation in check. And when inflation's in check, the Federal Reserve has a lot more flexibility to help modulate the economy, and that's a good thing on a lot of different fronts. So I expect that had a big part to play in the administration's decision to go into Venezuela. This whole conversation is nested in our federal budget deficit. And you can see on this chart here what we were spending last year. Our total expenditures amounted to $7 trillion. Of that, 17%, or 14% rather, is net interest on our debt. So as interest rates rise, that purple component that I just checked, that gets wider and wider and wider and takes up more and more and more of our annual deficit. Social Security does the same. Social Security is linked to inflation. Inflation and interest rates tend to move in tandem. Same way with Medicare and Medicaid. So you have 50% of our budget or thereabouts, which is either tied to or strongly linked to interest rates. And the Federal Reserve, all of our politicians, all Americans need to be mindful of this because it's a situation that we're going to need to manage in the coming years. And no solution is easy. We can cut expenses, we can increase taxes, or we can grow our way out of this. And I expect it'll be some combination of all of those. Okay, I mentioned the Federal Reserve's primary policy tool as interest rates, and I thought this chart might be helpful because I've also mentioned pockets of opportunity. And one of the pockets of opportunity that we're seeing today that we weren't seeing 2 years ago is in fixed income. So this is the bond component of your portfolio. If you look at a typical retiree, that portfolio is usually 60-40. The 40 represents allocation to bonds, and they're slower growth and they're safer. And as the Federal Reserve adjusts interest rates policies, what you can see is that the yield on those bonds goes up or down in accordance. You'll hear investing wonks like me talk about the short end of the curve or the long end of the curve. It's not that complicated, really. The short end of the curve is just what yields are when you lend money for a short period of time. The long end of the curve is just what yields are when you lend money for a longer period of time. In a normal market, it's riskier to lend for longer periods, so you would expect higher interest rates. That's what we see here with this blue line. This is the yield curve today. The Federal Reserve has lowered interest rates from 5% a couple years ago down to 3.5% today. And as we move out towards the longer end of the curve, we see interest rates go up and up to 4.2% on the 10-year and even a little bit higher if you want to move out further on the yield curve. Again, I refer to that as a pocket of opportunity, and the message there is not complicated, which is my perfect segue to this next chart. This is what I call the eye test, or maybe a better metaphor for this chart would be the quilt. It shows how assets move over time. Each of these little quilt squares represents an asset class over the last 20 years. If you go back to 2011, you see REITs, which is the light blue square there, returned 8.3%, and that was the highest yielding asset class. And depending on the year, you see those asset classes bounce around quite a bit. But diversification is your friend. And if you look at the center of the chart there, you see an asset allocation portfolio. This is that 60-40 portfolio that I just mentioned, usually right there in the middle. Right there in the middle is a recipe for success over time. Let your money compound, rebalance on a quarterly basis, take advantage of any tax loss harvesting, and work with your financial planner to create a nice, safe landing for yourself as your portfolio approaches the target landing zone. So that's my quarterly market update. That's my timeless wisdom. Please reach out to me with any questions. Please reach out to me with any suggestions. I'd love to hear from you. I'll be back in another 3 months with an additional market update. Thanks.